I am terrified. So, over the years, I've given you a lot of charts and graphs, and I've done my best to put them in historical context. But right now, I'm working on two significant economic pieces, just in terms of scope, and they have my head spinning. And they have me reflecting on economic cycles and history. So, one is a complete breakdown of Trump's budget and what it will mean for the average US citizen, and the other is related to the future of currency, interest rates, inflation, and just global monetary order. So, before we get into those, and I tell you what has me spooked, I want to get small for a minute. And I want to put something in everyday terms that will serve as a foundation for these broader episodes. So, here's the upshot. We've finally entered the inequality matrix where everything flips on its head. So if you feel like you've done everything in your power to get ahead, and yet you're still treading water or under it, you're not alone. In fact, you're in very good company with about 90% of America. But why? So we know that at this point, inequality is a thing, and we have a sense that it's real, it's not good for society, and all of that. But how did it get to be this way? I mean, did the billionaires really have a cheat code? Are we less industrious and hardworking than our parents and our grandparents, as the powers that be would have you believe? Is it the fault of the politicians who shipped our jobs overseas? Is it the debt that we've saddled future generations with? I mean, these are all the big time talking points, but we never really get to the core of the how did this happen issue. So for every question related to inequality, there's as many answers that range from it's your fault to immigrants. It's Democrats, it's Republicans. It's Wall Street, it's China. It's actually a lot more straightforward than that. And I think it's time to level set on inequality and just be honest about how things got this way. UNFTR. So as a quick preamble, I'm going to give you some charts and graphs just to lay the groundwork for this episode. 3 quick charts that were just released by the Conference Board that will illustrate what we've been saying for a while now, and then I'm going to share the only chart that matters in this moment to show you where all the money went before we then put it into historical context. So here we go. 3 quick charts to level set on the economy right now, and then the one that matters right after, and you'll see why these make sense in a moment. So the first 3, like I said, are from the Conference Board. They just released their June leading economic indicators charts, and it's pertinent because it's the most reliable recession indicator over long periods of time that we have. Though I'll give you my thoughts on recessions in a moment before we get to the important 4th chart. So you can see on this one, there are 2 lines. The blue line is the LEI, and if you have color distinction troubles, then it's the one that is declining at the tail end. The other one is called the coincident indicator. The difference is the coincident line measures economic health at the current moment. The normal line measures where the economy is supposedly headed, so it's a composite of slightly different measures. Easiest way to think about it is the coincident line is the point in time when the Fed, the business community, and the consumer are all managing to get by. Nothing too drastic has bottomed out like you see in the shaded areas during the GFC and the COVID crisis. Now, when these lines dip at the same time, it's like projections and the current holy shit data points come together. But you can see that typically the blue line diverges just ahead of the black line, which is why they pair these together as an indicator. So in this next chart, you're going to see red lines. They're horizontal lines between the dips that indicate when formal recession signals were called according to the indicators. So let's take a quick look. What's interesting about this is that you notice the red recession signal indicator most recently didn't correspond with a, quote, technical recession. So it's plain to see what happened in the dot-com bubble aftermath, the GFC, and COVID briefly. But we had high signals during the Biden inflation crisis that muted slightly in the beginning of the year, but now we're back in that territory again. So one of the reasons for this is that we're still dealing with the massive upheaval from COVID and inflation shocks, the supply chain shocks, Fed policy changes with respect to money supply, QE, interest rates. So in many ways, the macroeconomic picture has fundamentally changed over the last decade or so, but our approach to the numbers hasn't. So now add to the mix exploding deficits, and high interest rate burdens associated with it, the sell America trend of late, and tariff confusion, And it makes sense why some of this hasn't returned to normal. Of course, there's a bigger picture. But before we get there, one more important finding from the conference board. The headline here is important. Quote, a strong rally in stock prices was not enough to offset negative impacts from weak consumer confidence and new orders, end quote. So what this means is that equity market activity is considered in these figures because there is wealth accumulation and income associated with market gains, and that does affect how some people feel relative to their retirement accounts, dividend gains if they rely on the market for income, and the general narrative about markets. Now remember, our mantra is that the market is not the economy. And that holds true here, which is why I've circled the other figures because they're way more relevant to the larger picture. So we've got new orders down and unemployment claims on the rise. These are the real numbers that impact the real health of the economy on a macro level, meaning that you and I and everyone else feels this on a daily basis. Now, a certain very vocal segment of the boomer generation is living high on the hog from their investments, and those are the people who are on the business channels and writing op-eds every day telling you that the economy is fine. Meanwhile, the business and manufacturing sectors are still sitting on inventory that they front-loaded at the beginning of the year to get ahead of tariffs, but the new orders aren't coming in. That's why tariff inflation hasn't completely hit the consumer yet, because the economy is worse on the ground than the figures would indicate. But it's coming. Inflation is coming as well because the tariffs are simply too high now for producers to absorb going into the future, and we're already seeing it show up in current inflation data. And that's only going to get worse, which will fuel the continued decline in consumer sentiment. All right, so that's the boring stuff out of the way. And the reason I wanted to start there is to illustrate how shaky the foundation of the economy is, but also to show how stock market gains contribute to the healthy economy narrative. But these are false positives if prices are still going up, more people are getting laid off or unemployed for longer, and interest rates on credit cards, home mortgages, and auto loans aren't coming down. So now for the important chart that I wanted to show you, and we'll jump back and forth to fully contextualize it, but here's the first look at it. So with the help of AI, specifically Perplexity, I put in the compounded rates of annualized growth of a few asset classes and mapped it against real wage growth and total dollars in circulation from 1978 until today. So in terms of methodology, briefly, these figures are averages for major indices and adjusted for inflation to smooth the data. And I chose 1978 as the starting point because it relates to a few key events. First off, gold was fully indexed as an investable commodity by this time after Nixon pulled the dollar off it as a peg to value. It begins at the start of the stagflation crisis as well, which fundamentally altered monetary policy in this country and kicked off the modern era of massive Fed intervention and floating fiat currency. So you have real wage growth over a 47-year period benchmarked against compound annual growth of 5 major asset classes, and the dotted line there represents the absolute volume of currency in the economy. So at the top, you have the value of the S&P 500 with annualized returns of around 8%, but compounded over the period. Below that is the dotted line of currency. But below that, you have the value of art using something called the art market index and gold, which track together pretty closely. And then at the bottom, you have home and auto prices pretty close together with real wage growth all the way at the bottom. So what matters most to the average American not living on investments in the stock market, gold, or art is obviously the 3 at the bottom. But that's where most people store their wealth if they're lucky. So just over 60% of Americans own a home, and around 85% of cars on the road are owned. So those are the 2 main stores of wealth and value for the average American. But you saw how little those things appreciated relative to wage gains. They're slightly above it when you smooth out the numbers, but even here, actually, let's look at it again. You can see how they were essentially tied directly together for years and years before finally just slightly beginning to separate in the past couple of decades. But it's that top of the chart that is everything. That plus your entry point, and I'll explain that in a second. The increase in compounded value for assets like stocks, art, and gold is directly correlated to the increase in the money supply. So let's talk about compounding returns and entry points. The reason it's harder for young people to participate in this economy is because things like homes are the basis of wealth building for most people, but for the wealthy, they're just another asset class. And 4 out of 10 Americans don't even own a home, so they're completely locked out of this particular asset class if it keeps rising relative to their wages. And if interest rates remain high, it gets even harder. But I don't want to get into the weeds on rates and treasuries. I just want to talk about it in absolute terms about dollars available in the economy and who has them. See, when Nixon pulled the dollar off gold, it meant the Treasury was unleashed. They could print as much money as they wanted. And they printed money to run fiscal deficits, purchase other assets, shore up Wall Street during financial crisis after financial crisis, and just generally put more money in the system to boost economic growth and activity at certain times. But the mechanisms for this are usually at the central bank and corporate level. So money flows ultimately into treasuries, corporate debt instruments, and equities because they're able to absorb these flows. On the very rare occasion the government can fuel deficits by giving money directly to citizens, to you and to me, in the form of unemployment benefits or tax cuts or tax credits or stimulus funds, that's when it comes to us. But by and large, the money flows to institutional resources. Now, here's where it gets tricky but interesting. Sometimes the government stands on both sides of money flows as the buyer and the seller, giving money to corporations for very low interest rates only to lend it back to them through treasury bills at higher ones, thereby creating a financial arbitrage for investment banks and corporations. Now, you and I don't get to do that, but they do. So as we went hog wild sending gobs of cash into the system from Nixon forward, institutions as middlemen, from banks to big companies, stood in the middle, gobbling it up and putting it to use. And as the performance of these banks and companies increased as a result of easy money, they loosened the compensation and regulatory standards to incentivize executives through stock performance, as we covered in our buyback episode, and to boost share prices by being able to buy back shares. Or let them crater the financial system without being penalized when they blew up the housing market and the Fed bought their toxic assets back and gave them free money. These are all examples of how the money flowed through these corporations and banks and investment banks and then filtered through to individuals who controlled them, but not to the real economy. But here's the thing. There comes a point when money doesn't do anything more for someone than cover the basics. And you can think about your own life and budget. Let's say the cost of running your household, you have a middle class or upper middle class existence, and it's $8,000 a month to run your house, to pay your rent or your mortgage, your car payment, health insurance, education, food, entertainment, utilities, you name it, all in $8K. Now, let's say you bring in $10K after taxes. You might decide to use that extra $2,000 to buy stuff outside of the essentials. You might be saving for a big purchase down the road and be putting it away, but it still doesn't leave you with a lot of wiggle room. Now, let's say you have the same $8,000 household income every month, but you bring in $50. You probably spend pretty casually. Let's say another $10K in fun stuff. I mean, you're just killing it, right? But at that point, you're sitting with a financial advisor who's putting some away for college, paying down some other debt faster, investing in stocks and bonds, and maybe just a little gold and a little crypto, maybe. Now, same $8K per month, but you're a millionaire. And you're bringing in $100,000 every month after taxes. You're doing all those same things, but on steroids. But now that extra something at the top, you're gambling a bit. You're doubling down on NVIDIA. You're buying Bitcoin, gold, maybe a vacation home, and something that Jim Cramer told you to buy that day. Now, it turns out, if you're that guy, things have been pretty good. And you're those lines at the very top. You're making more on your money every year because the gains are compounding, and the government is making sure people like you never lose by continuing to flood the market with money. So your stocks, they're ripping. Gold, it's up. Maybe you have a nice piece of art from an auction, and that vacation home is now an income source because you rent it out 6 months of the year. So now let's talk about the jumping in point. If you're a young person just starting out today, Try jumping in at that point at the end of the chart. Can't be done. And that's why millennials have fewer assets. Gen Z can't find a good paying job, and Gen Alpha might as well move to India or Indonesia if they want to jump on this ride at something that looks like the beginning. Now take the individual earner to the corporate realm, and the inequality issue is magnified, but it's all tied together. Corporate America continues to hoard cash and reinvest it in either themselves or what's happening now, speculative assets. The same as that really wealthy individual, put it on a pedestal, put steroids in it, make it bigger than life, and that's corporate America. And that's the foundation for the bigger pieces that I'm working on and why I wanted to put this out there right now. You see, the easy wins have been gone for a long time. And now we've printed more money than even they know what to do with because the real economy isn't absorbing it. Not through shareholder returns, as evidenced by increased price-to-earnings ratios, through the bond markets, which refuse to quiet down and are pressing even higher because the rest of the world is beginning to recognize that we've reached peak money-to-asset ratios. Now, here's the thing. I fully expect these speculative asset classes to continue going up. Sky's the limit for Bitcoin. Gold as well, because they're not just American assets any longer. But not for the reasons you might think. These things are increasing because the US dollar is no longer the safe haven it once was. The Trump administration knows this, and so does every other central bank in the world, and that's the part I want you to remember for later. But the point of this exercise is to show you, in black and white, and gold, red, green, and blue, that this is how inequality shows up, and how the top 1% can insulate itself from periodic crashes. We've said over and over that the capitalist system is designed to boom and bust every 7 to 10 years, and it does so like clockwork. Only now we're moving beyond what capitalism has done in its very brief history because the fundamental models are breaking down. If you look at the low end of that chart, it's painfully apparent that the average American has been living in a recession since the start of this millennium. It's why consumer credit is at an all-time high, why most people don't have enough to retire, why younger people aren't able to buy homes, why you're treading water or just below it. See, capitalism, as it was originally intended, was designed to be heavily regulated and to have much of the surplus flow to the general public to account for general welfare. Those are the words of Adam Smith and the founders of this republic. But in the post-Bretton Woods era, from Nixon on, the system has been trending in the opposite direction. Slowly, steadily, regulations, they're disappearing. Capital accumulation has gone to the top, and the gains have been compounded by the very deregulatory actions of the policymakers and the people that stand to benefit. Both parties are complicit because we were the holders of the most valuable commodity on planet Earth, the dollar. So long as the dollar maintained its value and could be converted to real assets like homes and cars and food, gas, luxury items, whatever, then it meant the absolute number of dollars in your pocket determined how much or how many of these things you had. If you were just a wage earner over the past 47 years, you made just enough. If you had a way to take in more of those dollars, you had more than enough. But if you had a silly amount of money, you had the ability to take a few risks in assets like stocks that were never actually risky because they built a system designed to make the numbers go up all the time, even if the performance of those companies that those stocks represented didn't warrant it. And that, my friends, is a Ponzi scheme. And Ponzi schemes rely on there always being enough fresh money coming into it to prop it up. So most of us didn't participate. It is what it is. But it means those red horizontal lines in those downturns are even harder on the majority of Americans. So believe it or not, the next crash won't just affect the 90% who didn't participate in any of this, though it will be more painful for them than anybody else. It's finally going to smash that next level up. The top 5 to 7% who have more than enough to live really well, but not enough of that fuck you gambling money. Because right now, The Trump administration is trying to stave off the inevitable debasing of the dollar while simultaneously trying to debase the dollar because of their interest rate and money supply strategies that are directly at odds. Coming soon, by the way. So they're setting themselves up for the next era, the stablecoin era, to put the dollar on a ventilator and keep the experiment going for a little while longer, but doing this while ripping out the safety nets for tens of millions of Americans and investing in job-killing AI, inviting inflation through punitive tariffs, and literally forcing the world to reorient supply chains around us and look for alternative currencies means they're going to blow out the system from the bottom up. But what they're banking on is that the new global stablecoin monetary system will create a new private and opaque central banking system designed to pour all of that excess money, no matter what denomination it started in, into private hands and away from nation states. So, my friends, allow me to welcome you to the new feudal era, because capitalism, as we know it, is over. So there's your baseline for things to come, and the black and white and red, yellow, green, and blue explanation for why you're not just in the Trump recession right now, you've been in one all along. Here endeth the lesson. Thanks for going through that today. I hope you enjoyed it. I hope you got some use out of it. And remember, if you haven't signed up for our free weekly newsletter, you can do so today by going to UNFTR.com. If you're part of the Midas Mighty who's just joined the UNFTR channel and you're just discovering everything, welcome and thank you for welcoming me over on the Midas Touch Network with open arms. I really appreciate the collaboration and I look forward to future projects. If you can see your way clear to becoming a member of UNFTR to support the enterprise as we build it out, that would be wonderful. All of that information available at UNFTR.com. And remember, sign up for that newsletter, and I'll catch you in the next video.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the